I began my investing journey when I was just 11 years old. Though I didn't truly get started until a few years later, I dove headfirst into experimenting with different tactics such as timing stocks and charting. It was an exciting time, but ultimately profitless. That all changed when I stumbled upon Ben Graham's The Intelligent Investor in 1949. Two chapters in particular gave me the fundamental framework I needed for investing, and it all starts with recognizing that a stock is a part of a business. Instead of simply valuing a little ticker symbol, I began to consider a company's economic characteristics, management, and competitors. It was a game-changing shift in perspective. Another key takeaway from Graham's book was his Mr. Market analogy. Most people react emotionally to stock market fluctuations, feeling good when their stocks go up and bad when they go down. But Mr. Market is an unreliable and unsound partner, offering different prices all day long. You don't have to pay attention to them unless it's to your advantage to do so. It's a critical lesson for investors to learn how to detach from market noise and stay focused on the long-term goals. Investing in the stock market is like taking advantage of a roller coaster ride. Just like how people have their highs and lows, the market does too. The beauty of stocks is that sound American businesses that sell goods, pay people, and generate income can see their high and low points vary significantly within a year. This is what makes investing in stocks so remarkable. The stock market is not there to instruct you or tell you anything. It's just there to serve you when you want it to. One of the most important things to remember in stocks is that the stock doesn't know you own it. It's just a piece of a business, and you have to value the business like Graham taught. Forget about the price and focus on the nature of the business over the next 20 years to determine what it should sell for. In the world of horse racing or the stock market, success requires a keen eye for details and the ability to discern what truly matters. Rather than fixating on the odds, we must evaluate each competitor's potential, assigning a percentage chance of winning that adds up to 100. This principle of analysis also extends to the stock market, where we must consider not only past performance, but also the crucial concept of a margin of safety. Just as we wouldn't risk driving a truck that exceeds a bridge's weight limit, we must leave room for error when investing, preparing for unforeseen circumstances. When searching for businesses to invest in, we must prioritize those with enduring competitive advantages like a well-protected moat. A strong brand reputation, patent protection, or location can all create a sustainable advantage as long as the business is run by competent and honest management. 30 years ago, the world was captivated by the famous chess match between Bobby Fischer and Boris Spassky. As they analyzed the mind's ability to sort through billions of possibilities and narrow them down to just a handful of options, it became clear that the human mind is capable of extraordinary feats of focus and concentration. When it comes to investing, this same principle applies. With thousands of companies to choose from, it's essential to cast out irrelevant options and focus on the most promising opportunities. Rather than trying to pick the 10 best performers in the Dow Jones, for example, it may be more effective to think about the worst performing companies and eliminate them from consideration. At Berkshire Hathaway, we take a similar approach. We never invest in small businesses because they simply don't move the needle enough. Instead, we focus on larger opportunities that have the potential to make a significant impact on our portfolio. Of course, as our capital has grown, finding these opportunities has become increasingly challenging. But by staying focused and disciplined, we believe that we can continue to identify promising investments that will help us achieve our long-term financial goals. Ultimately, the key to successful investing is not about how many opportunities you pursue, but about how well you choose them. By staying focused on the most promising opportunities and casting out the irrelevant ones, you can build a strong investment portfolio that will stand the test of time. So take the first step and subscribe to our channel to learn more about the art and science of investing.